what's called clear indication. Indication, we call it indication of what we call of the origin of what we call the goods. So lastly, we have what's called clear indication of what we call the origin of goods. Are we together? This is because when you talk about clear indication, this is a scenario where different countries are charged different. This is where different countries, where different countries, we say are charged. We say are charged. The word are charged what we call different duties. So this is a scenario where different countries are basically charged what we call different duties. So you have to clearly indicate the origin of goods. So this is the tax planning opportunity that is available for what we call custom duty. Give me a yes if we are together. If that is at home, we respond with a yes. If that is at home, thank you, Samkid. So then I want to also move to a very good area, because again, in these areas will also assist you. You know, when you're talking about remuneration package altogether, you're supposed to compare. Let's say, for example, which option? Maybe you are in employment. You have option 1, option 2, and you're told which option should you go for. Are we together? Remember, when it comes to employment, we always go for the option that basically gives you the highest employment income. So you go to what's called remuneration. We call it remuneration. We call it remuneration packages. 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 So when it comes to remuneration packages, are we together? This is what we call evaluation of different benefits. This is what we call evaluation of what we call different benefits received by employees from employers. Are we together? Evaluation, we call it evaluation of what we call of different, we call it evaluation of what we call of different benefits received. The word is received by what we call by employees, and say from what we call from employers. So what we call different evaluation of different remuneration, different benefits that is received from employee by employees from employer, which is done where tax position of benefits is determined. Where tax position, where we say tax position of benefit is determined. Where the tax position of the benefits we say is determined. So I want to talk about a number of things together. I want to talk about a number of things in relation to this together. I want to talk about a number of things, but this is in relation to benefits. For tax purpose, how do we classify benefits for tax purpose? Benefits is basically classified into, for tax purpose. How many benefits do we have for tax purpose? How many benefits do you have? When you say for tax purpose, we say benefits. We say are classified. The word is classified. We say into. For tax purpose, benefits are basically classified into 2. For tax purpose, we say that the benefits are basically classified into 2. Which and which? For tax purpose, we say that the benefits are basically classified into 2. What are those 2 types of benefits? What are those 2 types of benefits? What are those 2 types of benefits? So we have cash benefit and non-cash benefit. So we say cash, we call it cash benefit, and then we have what we call non-cash benefit. So we have the cash benefit, and then we have what you basically call the non-cash benefit. So we start with what's called the cash benefit. We start with what's basically called the cash benefit. We start with what's called the cash benefit. What is the cash benefit? When you say cash benefit, What is the cash benefit? Maina, what is the cash benefit? So they accrue to an employee in monetary form. Benefit that accrue to employee in monetary in cash form. Accrue, so these are basically accrue to employee. We say to employee in what's called in monetary form. So they basically accrue to an employee in monetary form. That is what we call the cash benefit. So in relation to tax, they're basically classified as follows. We say classified, we say as follows. In relation to tax, they're basically classified as follows. So we start with the first one. We call it the main employment. What we call the main employment income. What we call the main employment income. So when it comes to main employment income, we are basically talking about salaries, wages, commission, sick leave, overtime, are we together, leave pay, etc. etc. together. When it comes to main employment benefit, we're talking about salary, wages. We can talk about salaries. Salaries, we have salaries, wages, bonuses, overtime, we have overtime, we have the leave pay, etc. So we have what called salary, bonuses, leave pay, etc. Are we together? Are they taxable? How would you treat those main employment benefits? Joy, how do we treat them? How do we treat the main employment benefits? Naomi and Tabla. So they're taxable benefits except, so we say taxable, we call them taxable benefit, and you say except what you call people with disability, except for what you call people with disability, except for what you call people with disability, where on salaries and wages, the first 150,000 is exempted from tax altogether. So when you talk about the main employment benefit, those are salary, wages, bonuses, overtime, we call them taxable benefit, except for people with disability, where the first 150,000 on salaries and wages is basically exempted from tax. We respond to this. Give me a yes if we're together. Perfect. So then we go to the cash allowances. We go to what's called cash allowances. So when Malimo talks about cash allowances, this particular area, I want to encourage you. This area is so easy to score marks very fast, especially where you're talking about tax planning. How can you plan? How can they reduce tax? It should be so easy. So this particular area, we should score a lot of marks much easier. So we talk about cash allowances. So when it comes to cash allowances, we have what's called the traveling allowances. We have hardship allowances. We can also have per diem, those cash allowances altogether. So if you look at the cash allowances, they basically if you look at the cash allowances, they're basically a taxable benefit. But except what? Per diem. So when you look at cash allowances, when you have what's called traveling, house allowance, hardship allowance, etc., the taxable allowance. So when you talk about cash allowance, we have traveling, we have housing allowances, we have hardship allowances, we have per diem. So the one is the taxable benefit, meaning the subject to taxation, taxable benefit, and you say except per diem, per diem. So if I made a statement, for example, I want you to answer this. If I said all cash allowances are taxable, do you think that statement would make sense? If I made a statement to say all cash allowances are taxable. Is that statement true? That is not true. Because of what? Because of per diem. That statement would not make sense because of per diem. For per diem, we say that as at 1st July, for per diem, as at 1st July, this would be tested this time. As at 1st July, we have it as 2025. The set limit, the first what? We say that the first 10K, we say is exempted. The first 10K is exempted from tax. That is as at 1st July 2025. Together, team. As of 1st July 2025, we understand that the first 10K is basically exempted from tax. Initially before that, what was exempted from tax? Initially before that, Samiki, it was 2K. But effective 1st July 2025, it was pushed to 10,000. Then we have the next on remuneration packages. We have the next, number 3. So on that number 3, we talk about employer paying school fee. Employer, we call it employer paying school fee, paying what's called school fee, and say on behalf of what you call of employee, on behalf of what you call employee and its dependents, on behalf of employees and is or are dependents. So employer paying school fee on behalf, employer paying school fee on behalf of what's called the employee and his dependents. So on behalf of employee, to employees, just say to employees dependents, just say to employees dependents, employees dependents. Who are the employees dependents? So when you talk about employees dependents, who would be employees dependents? Would basically family, children, or together, kids. Those will be employees dependents. So when it comes to scenario, in terms of remuneration package, when you're talking about employer paying school fee on behalf of employees dependents, we have 2 scenarios. We basically have a scenario where we tax, a scenario where it is taxable, and we have the second scenario where it's exempted, where we do not tax, not taxed. So we have a scenario where we taxed, and we have a scenario where we do not tax altogether. So when you're saying that employer paying school fee on behalf of employee to employees dependents, we have scenario 1 where we tax, and we have scenario 2 where we do not tax. Are we together? Where it's exempted from tax. So then we say that if number 1, when do we tax it? When do we tax it? That's the question. When do we basically tax it? That is scenario 1. When do we basically tax it? That is scenario 1. Scenario 1, when do you tax it? Employer expenses school fee in the income statement. Employer, scenario 1, employer, we say expense would call the school fee. Sorry, employer, we say expense would call the school fee. The school fee what's called in the income statement. In the income statement. Scenario 1, where the employer basically expense would call the school fee in the income statement. So we say scenario 1, where the employer expenses school fee in the income statement, meaning that it was treated, to say it was treated as allowable expense. It was treated as allowable expense. In this scenario, you're going to tax the employee. Are we together? It was not taxed on the employer. If it was expense in the income statement, It basically means that it was not taxed on the employer. So you're going to tax it on the employee. I don't know, are we together? We respond with a yes. If we are together. Are we together? Perfect. Scenario 2, we say that if the employer did not include it, if the employer we say did not include, if the employer did not include, if the employer did not include school fee, if the employer did not include the school fee, we say in what's called in the income statement. In the income statement. If the employer did not basically include the school fee, we say in the income statement altogether. So it would be treated as an unallowable expense. In this case, we say treated as non-allowable expense, as non-allowable expense. Treated as what we call non-allowable expense. This scenario 2, it is exempted from tax, not tax or exempted from tax. Not tax or we exempted from tax. Exempted from tax, not tax or exempted from tax. So if you're calculating a remuneration package altogether, scenario 1, we are told that school fee was included in the income statement, you are going to tax. Say option 2, you are told school fee was not included, so you do not tax. We respond with a yes. That is not a benefit. If the employee pay for himself, is it a benefit? That's not a taxable employment benefit. That's not a benefit. Yes, then that is not a benefit. Somebody also asking a question. Remember, this is under employment benefit. Let me get back to. Do siblings classify as family? Sibling, you mean brothers and sisters? Do siblings classify as family? Do you mean brothers and sisters classified as family? And Naomi. But that's a part of the family. Those siblings are part of the family. Yes. Those are part of family. Those are part of the family. So then we go to what's called medical benefit. We proceed to what's called the medical. We call it the medical benefit. Call it the medical benefit. So we get to medical benefit. So when you talk about medical benefit, we say that this is where employer pays for what's called medical expense. Employer, we say employer pays for what's called pays for what's called medical expenses, pays for what's called the medical expenses. Employer pays for what's called medical expenses of employees and dependents. Employees and dependents. So this is a scenario where employer pays for medical benefit for employees and what's called the dependents, employees and dependents. So under this, we also have two scenarios. So we say tax as follows. So this is taxed, and we say as follows. Tax as follows. Tax as follows. So number one, we say tax exempt. Tax exempt. When is it tax exempt? When is it tax exempt? When are we not taxing? If that medical, we say that covers all employees. When it covers all employees, are we together? When you say if it covers all employees, covers what you call all employees. So if it covers all employees, we do not. If it covers all employees, it is tax exempt. We do not tax. Are we together, team? If it covers all the employees, then it becomes what's called tax exempt. So the other name is what's called non-discriminative. That is what we call a non-discriminative. Non-discriminative, we call it scheme. We call it a non-discriminative scheme. We call it a non-discriminative scheme. So then we tax scenario 2 where we tax. So on scenario 2, we basically tax where we say that we tax where it covers a few employees. It covers what's called a few employees, where it does cover what we call a few employees. So scenario 2, we basically say we tax basically where it covers a few employees. For example, if you thought the medical bill was only available for senior employees, then in that scenario, you tax. So that scheme, we call it discriminative. We call it the discriminative scheme. 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 So a discriminative scheme, you will basically tax together. So we go to the next benefit. We call it insurance. Insurance benefit. We call it the insurance benefit. I will talk about that, all that. I will talk about that. Though it's not something that is not being asked, but I will talk about that. Are we together? I will talk about that. Naomi, I'm saying I will talk about that. Hold it. Are we together? Though it's not something that you're not going to be asked, you're just going to be asked on that. Yes. I will talk about that. Yes. So then you go to insurance benefit. What call insurance benefit? Insurance benefit. So whenever we talk about insurance benefit, we say that employer meets insurance expense for the employee. Employer, we say employer meets what we call insurance expense for what we call for employees. Insurance expense for the employees. So we have the employer basically meeting insurance expense for the employee. That we call it an insurance benefit. Employer basically meeting insurance expense for the employee. We call it insurance benefit. If you're paying it for yourself, Sami Keys, then that's not an employment benefit. If you're basically paying for yourself insurance, then that is not an employment benefit altogether. But however, we say that under both scenario, if it's a medical cover, if it's education cover or a life cover, they're all entitled to what we call an insurance relief altogether. So we have, if it's paying that, are we together? Life insurance cover or education cover by employee. Life, you can have life or what we call education cover. Education cover. So the one is such is a taxable benefit. Such, we say, is what called is a taxable benefit. Such is a taxable benefit. Such is a taxable benefit. Give me a yes if you're together. Such is a taxable benefit. Perfect. Then we go to employer's contribution on behalf of employee. Employer's contribution. We call it employer's contribution. Employer's contribution. Employer's contribution. Contribution to or contribution, and say on behalf of what's called employee, on behalf of employee to what we call to a pension, to what we call a provident fund, to a pension scheme, to a pension, or what we call a provident fund. So when you talk about such contribution to a pension or what's called a provident fund, there are two concepts to it altogether. Number one, we have what's called a registered pension. Number one is what's called a registered registered pension. Examples of a registered pension. Example of a registered pension. Example of a registered pension. NSSF particularly. So repeat number 5. So number 5 is saying that insurance benefit. Employer meets basically insurance expense for employees. Joy, are we together? Employer meeting insurance expense for the employee. For example, maybe it's meeting your life cover or education cover. You're saying such is the taxable benefit. Such is the taxable benefit. Together, Joy. Together, Joy. Are we together, Joy? Yes, that's a taxable benefit. Such is a taxable benefit. Perfect. So then we were on pension scheme. So that was the next pension scheme. So the employer basically contributes on behalf of employee to a pension scheme. And I say when you talk about pension scheme, we have registered pension scheme and non-registered pension scheme. Non-registered pension scheme. So examples of a registered pension scheme, we say is a registered pension scheme, we say e.g. NSSF. NSSF is a registered pension scheme. How do you treat that? If employer pays on behalf of employee to a registered pension scheme, such is what? We call it a tax exempt. Such is what we call a tax exempt. Such is a tax exempt. Are we together? Such is what we call a tax exempt. Give me a yes if you're together. Such is a tax exempt. Are we together, team? Such is. So the second scenario, we say taxable if the scheme is not registered. Such taxable if what do you call the scheme is not, the word is registered. Taxable if the scheme is not registered. So the second scenario, we say that it's taxable if the scheme is not registered. Taxable if the scheme is not registered. We respond with a yes if we are together. We respond with a yes if we're together. And this area, I want you to scoop marks because I know it will come this time. Then we have what we call the cost of passage benefit. Cost of what we call the cost of what we call of passage. The cost of passage. The cost of passage. So what is the passage? We need to understand what is the passage. Cost of passage benefits. What is passage? So when you talk about passage, this is the cost of moving from one place to another because of employment paid by the employer. Cost of moving from one place to another. Cost, we say, of moving, we say from one place, we say to another, because of employment, we say because of what they call of employment, cost of basically moving from one place to another, because of what we call employment, because of employment paid by the employer, paid by the employer, paid by the employer, paid by who? By the employer, paid by the employer. Together, team, paid by the employer. Are we there, team? Paid by the employer. So we say in taxation, for it to be tax exempt, we say if it is tax exempt, for it to be tax exempt, for it to be tax exempt, meaning other scenarios other than the ones that I'm mentioning, you're going to tax. For it to be tax exempt, we say it must meet what we call the following. It must meet what we call the following conditions. For it to be tax exempt, we say it must basically meet what we call the following condition. For it basically to be tax exempt, we say it must meet the following conditions. Are we together? So number one condition for it not to be taxed, are we together? Employee should be an expatriate or what we call it, non-citizen. Employee, number one is employee. Employees what we call a non-citizen or an expatriate. If employee is an expatriate, it is not tax. Together, join. If employees is an expatriate, it is not taxed. Give me yes. The second scenario, employees in Kenya for the sole purpose of serving the employer. Employee is in Kenya. We say for the sole purpose, we call it purpose of what we call of serving what we call the employer. Serving what's called the employer. Employee is in the country for the sole purpose of serving the employer. Employee is basically in the country for the sole purpose. He's not engaged in anything. What brings him is basically in the country for the sole purpose of serving the employer. But lastly, the whole amount in question is basically spent on passage. So say the whole amount, the word is the whole amount. We say is spent. We say is spent on the passage. The whole amount is basically spent on passage. So we call it the whole amount is basically spent on passage. The whole amount is spent on the passage. So if it does not meet above the three conditions that we're mentioning, then we tax. Are we together? I'm saying if it is taxable if it does not meet the above condition. And B, it is taxable if it does not meet the word meet what's called the above conditions. If it does not meet the above condition. So saying that it's basically taxable if it does not meet basically what's called the above condition. It is taxable if it does not meet the above condition. If it does not meet what's called the above condition. It is not taxable if it does not meet, if it is taxable, sorry, if it does not meet the above conditions. The conditions that we have makes it exempt. Give me a yes if we're together. Give me a yes if we're together. So then you have what's called employer's contribution on behalf of employee, employer's contribution. We call it employer's contribution on behalf of what we call of employee, on behalf of employees, to what we call to a members club. To a members club. The last one, the cash benefit. Employer's contribution on behalf of employee to a members club. Are we there, team? If you're there, we'll give it a yes. We shouldn't get tired. Good things will always, we say that if you want a good thing, you have to keep on moving. Is it true, Joy? Naomi? If you want anything good, you must be persistent. If you want anything good, you have to be persistent. Are we together? And again, the goal is not just to pass exam. I want us to understand two things. I want us to understand two things, you know. I can come and give you shortcuts, but again, it must be balanced with the syllabus. Again, giving you shortcuts and syllabus, there must be a balance. Aaron, there must be a balance. Are we together? We can decide, go to papers, revise and say this and this and work it out and we make sure we pass. But again, you realize that when you step out, one of the most important parts of this aspect is the knowledge. Is it true? Aaron, is it true? Yes, one of the most important aspects of learning is knowledge. When you step outside, you notice that it's not even the passing. It is the knowledge. Yes. I know some of you will disagree with me in this class, but one of the most important parts of it is the knowledge. Because if you have the knowledge, then you're not dependent on anybody to do anything without knowledge. You can use it for yourself. You can create a need with it and do something with it. So one of the most important aspects of it, even classes altogether, is that the content covering must also be complete altogether. We can decide to just fix things and we pass, but the knowledge is also very important. So then we get back to what's called employer's contribution on behalf of employee to what's called a members club, to what we basically call a members club. Employer's contribution on behalf of employee to a members club. So number one, we say that it is the tax exempt if it's related to the work of employee. We say tax exempt. We say tax exempt. We say tax exempt if it is related, the word related to what? To the work of employee. To the work of employee. It is tax exempt if it's related to the work of employee. It is what we call tax exempt. We say if it's related to the work of the employee. So basically saying that it is tax exempt if it's related to the work of employee. So that is to say, for example, contribution of what we call on behalf of contribution on behalf of accountants to is come together. Contribution, e.g., contribution, we say on behalf of what we call of accountants, on behalf of what we call accountants, to what? To ISPAC. On behalf of accountants to ISPAC. So this is exempted from tax, implying that if that members club does not basically relate to the work of employee, then you're going to tax. You are going to tax. Give me yes, some kids to get together. If that contribution to members club does not relate to the work of employee, it basically means that you're going to tax. I've finished on the cash benefit. So we go to the non-cash benefit. We go to the we call it cash benefit. We call it the non-cash benefit. We call it the non-cash benefit. So when you say non-cash benefit, what do you basically mean by non-cash benefit? When you say the non-cash benefit, the non-cash benefit, the non-cash benefit. When you say non-cash benefit, so they accrue to employees in non-monetary form. So basically say accrue to what? To employees. They accrue to employees in what's called in non-monetary. We call it non-monetary form. So they basically accrue to the employees in non-monetary form. They basically accrue to the employee in non-monetary form. Non-monetary form. They basically accrue to employees in non-monetary form. So examples, we get to the example. So we start with example one. Aaron has given us the first one. We start with example one. We call it one is benefit. We call it benefit in kind. Number one is what's basically called benefit in kind. We call it the benefit in kind. Number one, we call it the benefit in kind. So what is benefit in kind? When you say benefit in kind, what is benefit in kind? What is benefit in kind? Benefit in kind. So these are given in form of what you call goods from employer in form of goods, in form of what you call goods by the employer, in form of goods by the employer. We can also have free transport, transport, etc. Free transport, etc. Free transport, etc. Free transport, etc. Free transport, etc. Free. We can also have the meals to staff. Are we together? We can also have the meals to staff, etc. Those are benefit in kind. Together, team. Those are benefit in kind. We respond to this. Those are benefit in kind. Yes. Perfect if we are together. So then we're saying that what is the set limit based on changes that were effected in November, December? What is the changes? What is the changes? What is the changes based on benefit in kind? It was pushed to, are we together? It was pushed to, initially it was 3,036. What was it pushed to, benefit in kind, based on the changes that were effected on 2024? It was pushed to, if you look at the benefit in kind was moved to, what was it moved to? We say initially it was 3,000 per month and 36,000. If it's above that, you tax. If it's less than that, you don't tax. With the changes that were effected in December 2024, what is now the set limit? Stomach is to 5K and 60K, 5 and 60K. Are we together? Stomach is 5 to 60K, 5 per month and 60K per annum. Together, team. Are we together? So 5K to 60,000. But there's a confusion. There's something that people normally confuse altogether. We say that there's always a confusion. Say taxable if the total taxable. Just say based on those taxable. Say if the total, we say taxable if the total. We say taxable if the total. Taxable if the total, taxable, we say that taxable if the total value is 5,000 per month, or what it costs 60,000 per annum. Above, if it's above, are we together? 6,000 per annum and above. Are we together? So for this, when it comes to calculation, when you're calculating, once it's above, do we less? We don't less. If it's above 60, if it was for the whole year above 60, do we less the 60? You see, some people confuse it with per diem. We say that 5,000 per month and 60,000 with the changes that were effected, with the changes that were basically effected in December 2024, they were pushed to 5 and 60,000 per annum on the limit. Naomi, are we there? Naomi, are we there? Perfect. So as opposed to per diem, remember per diem, if you're checking the per diem, presently, you're going to say less than 10,000. So you're going to say above 10,000 is what you tax. But not for the benefit in kind, once it's above 60,000, let's say, for example, 80,000. How are we going to deal with 80,000 if the per diem benefit in kind? Are we going to less 60? We don't less the 60. We use the whole amount. We just checked. If it's above 60,000, we tax. We don't, not above that. Once it's 80, once it's above, we don't less. The whole amount together. So then the second scenario we have, we say number two. Number two, we talk about what's called services provided by employer to employee. Services, we say provided by what? By the employer. By the employer to what's called to employee. Services provided by employer to employee. Services that we say are provided by employer to employees. Services that we say are provided by employer to employee. Services provided by employer to employee. So the first one, we call it telephone. We call it telephone. We call it telephone. We call it telephone. We call it telephone bills. Telephone bills or airtime. Let's say for what's called for private. We say for private use. So what you call telephone bill or what you call airtime for what you call private use. How telephone bills, how do you go about it? Telephone bills, how do we basically go about it? For the telephone bills, for the private use, how do we basically go about it? So when we talk about telephone bills, how do we go about it in relation to taxation? How do we go about it? How do we go about it? So what is the taxable amount? So the taxable amount is 30%. We say taxable amount is equivalent to 30% of what we call of the telephone bill. So we say 30% of what's called the telephone bill, 30% of the telephone bill. Give me a yes if we are together. Good people, if you're together, we respond with a yes. Good people, if we are together, we respond with a yes. Perfect. So then we go to what's called provision. We call it provision of fully furnished house. Provision, we call it provision for what we call for fully furnished house. Provision for what we call a fully furnished house. How fully furnished house? In most cases, when you have furniture benefit altogether, there's always the house benefit altogether, the housing benefit. How do you tax the furniture benefit? Furniture benefit. So for the furniture benefit, we say 1% times the number of months, 1% times the number of months, times what you call, times the cost of furniture. Then you say times the cost of what you call of furniture, times the cost of what you call furniture. So 1% times the number of months. If you're there for the whole year, then you multiply by 12. If you're in the house for 6 months, then you're going to use, say, 6 altogether. So then we have what's called provision for servant. We have provision, call it provision of what we call of a servant by the employer. Provision of a servant by the employer. We have what we call provision of a servant by the employer. Provision of a servant by the employer. What we call provision of the servant by employer. Provision of what we call of the servant by the employer. Call it provision of the servant by the employer. So a servant would mean you have a cook, you have a house help, cook, house help, e.g. You have a cook, we have house help, we have gardener, etc. We have the gardener, etc. Provision. We have provision of what we call of employee, which can have servants to the employee. For example, you've been given a cook, you've been given a gardener, or you've been given a watchman or a gardener. So taxable amount is the higher of. We say taxable amount we say is what's called is the higher of. So the taxable amount is basically the higher of. So what are we comparing? We say that the taxable amount is basically the higher of. So we say cost to the employer. We have cost to the employer. You compare with what's called the market rate. You pick the higher. You compare the cost to the employer, how much the employer is paying, and then you compare with what's called the market rate. Is that at home? If we are at home, you give it a yes. We give it a yes. Perfect. However, most of the questions you're not given the market rate. Presently, they don't give the market rate. So just once you have the cost to the employer, that is what works. In most questions, presently, you do not have cost to the employer. So we talk about provision of water and electricity. We have what's called provision of what we call of water and electricity. So provision of what's called water and electricity. So on the provision of water and electricity, I want us to be keen on something, provision of water and electricity. So we compare the higher of. We say that the higher, we're not going to write the higher of what we call of, cost to the employer, We have cost to the employer. We have cost to the employer, the higher of, cost to the employer. We say cost to the employer. And what we call commissioner's prescribed rate. Commissioners, we compare with commissioner, prescribed rate. This is provided in the tax table, provided in what's called the tax table, provided in the tax table. So I want us to look at it. So if you have a copy of tax table, kindly let's open the tax table. If you have the tax table, if you have what's called the tax table, we open the tax table. If we have the tax table, we open the tax table. Kindly. So we're saying that cost to the employer, you compare with the commissioner's prescribed rate. Do you have the tax table? If we have it, we respond with a yes. If we have it, we respond with a yes. So on that tax table, I want you to look at items below the bordered table. Items below the bordered table. Commissioner's prescribed rate. Commissioner's prescribed rate. Are you seeing that? Thank you. So we are talking about electricity. Look at electricity. If it's communal or from generator, if it's communal or from generator, we say 1,500 per month or 18,000 annually. If it's water, that is basically communal or from borehole, that is 500 per month or 6,000 per annum. So if you're looking for electricity, we are going to say if it's basically communal or from a generator, we are going to say the cost to the employer we compare with 18,000. That is annually, we compare with 18,000. Together, we compare with 18,000. That is if it's the whole year. So if it's the whole year and electricity is basically from communal or from generator, the cost to the employer we're going to compare with 18,000. So we pick the higher. If it's water and specifically communal or from borehole, we are going to say that is the whole year. We are going to compare the cost to the employer with 6,000. Are we able to see that? Are we able to see that? If we are able to see that, we respond with yes. Perfect. However, on a rare condition, you can be given for agricultural. If they say agricultural employee, are we together? For agricultural employee, remember the subsidized reduced rate of benefit. For agricultural employees, you can see this reduced rate of benefit. If it's water, for the whole year, it is 2,400. So you compare the cost to the employer with 2,400, but the mark that is for agricultural employee. On the side of electricity, that is basically on the agricultural employee, we know that for a whole year, the commissioner's prescribed rate is 10,800. You compare with the cost to the employer. We compare with the cost to the employer. We compare with the cost to the employer. We respond with a yes if we are there. If we are there, we respond with a yes. Give me a yes if we're together, if that is understood. So I want us to move to the next thing. I want us to move to the next thing. So we move to what we call provision of motor vehicle. We have what's called provision. So the next should be provision of what we call of motor vehicle. We call it provision of motor vehicle. We call it provision of motor vehicle by employer to employee, by employer to employee, to employee, and you say for private use. So you say that provision of motor vehicle by employer to employee for private use. Provision of motor vehicle, provision, we call it provision of motor vehicle by employer to employee for private use. For the private use. Provision of motor vehicle by employer to employee, and you say it for private use, for private use. So we say the taxable amount, if the motor vehicle number one is owned by the company, motor vehicle is basically owned by the company. Number one, if the motor vehicle is basically owned by the company. Are we together, Aaron? If the motor vehicle is basically owned by the company, the taxable amount, we say that the taxable amount, come in and say that the taxable amount, so the taxable amount in that scenario, we say the taxable amount in that scenario, we are going to say that 2%, look up 2%, times what? Times months, times, look at the word, initial cost of what we call of motor vehicle. Look up. So look up initial cost, not the net book value, not net book value, not net book value. So we say 2% times the number of months times what you call initial. If you're given the net book value, what should you do back? And you're given the position. How do you get the initial value? If you're given the net book value and you're given the position, how do you get the initial value? You add back the deposition to get the initial value. You add back the deposition to get the initial value. So this one, you compare with what's called motor vehicle. We have what's called motor vehicle CC. CC means cubic capacity. So you get the higher of that. You get the higher. But interestingly, I want us to go back to that table so that we just get a few points on it. We go back to that table. We go back to the table. We go back to the table. We go back to the table. Look up on the border, on the right-hand side. On the right-hand side, you can see prescribed. Are we there? Are we there? Perfect. So for motor vehicle, look at the different categories of motor vehicle. So it's saying the first type of motor vehicle, we have saloon cars. We call it saloon cars, hatchbacks, and estate. We have what we call saloon car, hatchbacks, and what we call estates, hatchbacks, and what we basically call estate. So we've been told that up to 1200 cc, the benefit is 3,600. That is per month. Then you have 43,200, that is per annum. 43,200, that is per annum. So we have between 1,201, 1,201 to 1,500 cc. The capacity is 4,200, that is per month, and 50,400, that is per annum. Then you have between 1,501 cc to 1,750 cc. The capacity should be, that is 5,800, that is per month, to 69,600. Are you able to see that? That is if you're given for saloon car, hatchbacks, and estate. However, an examiner can give you unconverted. So that is the panel vans, particular pickups, panel vans. So we have up to 1,700 cc. Per month is 3,600. Then per annum is 43,200. However, if it's over 17, meaning 3,000 is unconverted, let's say a pickup, and it's 3,000, that is over 17, that should be 4,200 per month and 50,400 per annum. Are we together? Then lastly, look up, we have the Land Cruisers, Land Rovers, and Cruisers. Are we together? Land Rovers and Cruisers. Mark. So for the Land Rovers and Cruisers, per month is 7,200 and per annum is 86,400. So number one, when you're basically dealing with motor vehicle, you have to check which kind of a motor vehicle is that. Is that altogether? Sometimes the examiner has given you a cruiser and you're using what is here. So you have to check on that. That's number one. Is that noted, CPA Sami Kids? Sami Kids, is that noted? If that is noted, you give Mwalimu yes. Naomi, is that noted? I hope that is noted. I hope that is noted. Then the second thing, if they just have a general, and they told you generally, they just tell you motor vehicle, what are you going to use? You're going to use what is happier. That is saloon car, hatchbacks, and estate. If they don't say anything, you just say motor vehicle, it was provided with a motor vehicle. You don't use pickups and you don't use Land Cruisers. You only use what is on top. So top, that is saloon, hatchbacks, and estate, and estate. I hope you're together. So you compare. Is that noted? If that is noted, you give me a yes. Are we together? Then lastly, on that, look up per month. So not everything, you can't choose the whole year if it's 6 months. If it's 6 months, what are you supposed to use? Let's say, for example, 1200 cc for hatchbacks. If it's 6 months, if it is there for only 6 months, what will be the benefit that you compare with? 2% times number of months and that. What will be the benefit prescribed cc for 6 months? If it's a saloon car and it's 1200 cc, what will be the benefit for 6 months? What will be the benefit for 6 months? What will be the benefit for 6 months? Yes, I have of that. Perfect. Thank you. Sometimes people forget that. Perfect. So you compare those two, then you get the higher. Then you say that number two, the second scenario we say that if the motor vehicle is hired, if motor vehicle, we say that if motor vehicle, we say is hired is to what we call leased from what we call from the third party. If the motor vehicle is hired or leased from third party, if the motor vehicle basically is hired, leased from that third party, what do we use? We say we ignore the criteria. Number one, ignore what's called the criteria, and you use what? And use what's called, and use what's called the lease, what we call hiring value. So if the motor vehicle is hired, leased from third party, we ignore the criteria, this criteria, and use what we call the lease value. Let's say, for example, the motor vehicle was hired. From third party at 20,000 per month. What is the motor vehicle benefit for the whole year? If the motor vehicle is 30,000 cc, but it was hired from third party for 20,000 per month, what will be the motor vehicle benefit for the whole year? Are we going to use this? We're not going to use this. That will be 240K. Thank you. That will be 240K. That will basically be 240K. Then before I give you a break, we talk about the last concept under motor vehicle. We talk about what we call the last concept under motor vehicle. If the car is partly, if the car is partly used, and you say for official purpose, partly used for official purpose. If the car is partly used for official purpose, and partly private purpose, and partly private purpose. If the car is used what we call partly for official purpose and partly for private purpose, the taxable benefit, we say that the taxable benefit NB, the taxable benefit is what we call the part that is private. Are we together? So the taxable benefit is the private part, is the part that is used privately. Are we together? Because official is not a benefit. Are we together? What is a benefit? Are we together? Benefit is, if a motor vehicle is partly used for official, is official a benefit? No. So, and partly used for private purpose. So private purpose is what will be taxable. The taxable benefit is the private use. For example, a given scenario, you say 40% official, we have 40% official, and then we have 60% private. So what will be taxable? So in this case, if we have this, we know that the private will say times 60. If that, then times 60. Together, we will apportion. What is going to be taxable is the private use. Respond with a yes. What is going to be taxable is what we basically call the private use. Give me a yes, Tim, if we are together. If we are together, we respond with a yes. We respond with a yes. Perfect. So now I can give you a break. So we can have our 10 minutes break, then we come back. We can have our 10 minutes break, then we come back. Start from now what's called the housing benefit. We call it the housing benefit. The housing benefit. So we stopped it. We were able to finish that. So we go to the housing benefit. We can start it on this other end. So we call it the housing benefit. We call it the housing benefit. We call it the housing benefit. So when it comes to housing benefit, Tim, I hope we're ready. Housing benefit. So we say that this is where if employer providing a house to employee, if an employer basically provides what we call house to employee, such is a taxable benefit. If employer, we say provides what we call a house, so what we call accommodation, we say to the employee, we say such is what we call is a taxable. Such is a taxable benefit. We say such is basically a taxable benefit. So if an employer basically provides a house to an employee, such is a taxable benefit altogether. So then we have a whole-time service director. Are we together? Or normal employees, what we call all-time service directors. We have what we call classifications of employee. We have what basically called classification of employee, what we call classifications of employee, where we have what's called a whole-time service directors, all-time service director, or we have a normal employees altogether. So taxable benefit for such all-time service directors or normal employee, taxable benefit for the house, taxable benefit, we say for that taxable benefit, we're going to say that 15% of what we call, we say 15% housing benefit for such. This is for the housing benefit. Housing benefit. So we need to start here 15. This is all-time service directors. These are normal employee service directors. So this one do not control, We say that they do not control. They do not basically control. They do not control more than 5% of the shareholding. So we say that 15%, we say 15% of what we call of the employment income, 15% of the employment income, 15% of the employment income. Remember, for housing benefit, when you're getting the housing benefit, is the last item. You get what's called other benefits. Is when you get what's called the housing benefit. So remember, in scenario where it's not given in cash, remember for the housing benefit, it will be the last item that you work out. Give me a yes if you're there. If it's not given in cash, look up team, it will be the last item. So we're saying that for all-time service directors who are the normal employees who do not control more than 5%, we say that 15% of employment income, you compare with what's called rent paid, market values to what you call the rent paid, market value, to what you call the rent paid, to what you call the rent paid to third party. So you compare, you get the higher. So 15% of the employment income, you compare with the market value. So what you call the rent paid to the third party, which can rent paid to the third party. And if there's own contribution, if there's something you contribute to get a team, we respond with yes. Give me a yes. Give me a yes. So the second category, I will not discuss the part. The part is not very necessary. I will talk about what about 30% used to deduct? Which 30%? What about 30% we used to deduct? 30% to deduct? Maybe expound on that so that we can answer you back. 30% of? Tamikis. 30% to deduct? What is the 30% you're talking about? No, that is for pension. That is for pension. Contribution to pension, allowable deductions. Samikis, that is pension, contribution to pension. Yes, remember, contribution to pension. So then we have the second category. This is agricultural. We call them agricultural employees. We have what's called agricultural employees. So whenever we talk about agricultural employees, whenever we talk about what we call the agricultural employees, these are those who live in a plantation. These are employees who reside in a farm. They basically reside in a farm or a plantation, or reside in a farm, reside in what's called in a farm. So what we call plantation. They basically reside in a farm, so what we call a plantation. So they reside in a farm, so what we call a plantation. They reside in a farm, so what we call a plantation. So for these ones, we say that when you're getting the housing benefit, if you look at housing benefit for this housing benefit for them, if you're basically looking for the housing benefit for our way together, if you're looking for housing benefit for agricultural employees, we say 10% of what we call of employment income, 10% of employment income. That is say rent paid, or what we call market value, or you compare with the market value, you get the higher. So look at for agricultural employees who reside in the farm. Are we together? Agricultural employees who basically reside in the farm or the plantation, Florentina, we use 10%. Is that noted? We use 10%. Agricultural employees who reside in the farm, we basically use 10%. So you compare the two and get the higher. Then you say on contribution, you less on contribution, contribution towards rent. We have what's called own contribution towards rent. Together, then you less what's called own contribution towards rent. Together, we have what's called own contribution towards rent. Together, own contribution towards rent. So now it says pardon, and I will be back. Number one now, when I talk about agricultural employees, these employees basically reside, we say they reside in what's called a farm. They reside in a farm or a plantation. But for the agricultural employees, we say that the housing benefit, we use 10%. If they reside in a farm, we use 10% of the employment income. You compare with the rent paid or what's called the market value, then you less what's called own contribution towards rent. We less what's called own contribution towards rent. Now, are we together? Then we less what's called own contribution towards rent. Perfect. So as an NP on this, as an NP under this, if these employees reside, if they reside outside the plantation, outside what's called the plantation. Plantation, if they basically reside what you call outside the plantation, what would you say? We'll use 15%. We'll basically use 15%. Instead, we call it instead of what we call 10%. If these agricultural employees basically reside outside the plantation, we use 15%. Are we together? We use 15% instead of 10%. The 10% is applicable when they reside in a plantation or a farm. So the 10% applies when they reside in a plantation or what you call a farm, or what you call a farm. Give me a yes if you're together. If you're together. Perfect, perfect. So the circumstances where housing benefit is not taxed together. The circumstances where we do not tax the housing benefit, where when it's a necessity, for example, when it's a necessity, for example, in case of a caretaker, that's a necessity. We don't tax it under that together. The second reason, it is for security purpose. That is basically for those who live in a war, who reside in a war-prone areas together. Houses are not taxed because it's for security purpose. Number one, you talked about necessity. Are we together? For example, as a caretaker, you need a house. Then we talked about what you call for better performance of one's duty. For example, when you have matrons who need to wake up very early in the morning, when you have nurses, those houses, they're not taxed because they're for better performance of one's work altogether. So those circumstances, we don't tax what they call the housing benefit. We respond with this if we are together. We respond with a yes if we're together. We respond with a yes if we're together. Thank you so much. Thank you so much. And like we said, we have to keep on going. We have to. I know sometimes it's a little bit hectic. Sometimes you've got a lot of things, that are pushing you. Some to the right, some to the left. But we've got just to make the decision to move. Are we together? We've got to make that decision to move. Whether we are facing challenges, we just keep on doing the right thing. And the right thing is to keep on learning. Are we together? The right thing is to keep on learning. So then we get to the next week, which call employee share purchase option. We can talk about employees share purchase options. Employees share purchase options. So under employees share purchase option, we are basically talking about this scenario is either given shares for free, are we together? Where employees basically given shares, we say shares for free, is given shares for free, or we say at a discount. So employees basically given shares for free or is given at a discount. So we have what's called the next is employees share purchase option. Are we together? Given shares for free or given at a discount? Together. So if it's given for free, are we together? If it's given for free, the taxable amount, that's the benefit. Taxable amount, if it's given for free, the taxable amount should be number of shares given, number of shares, we say shares given, times what? Times the market price. So the taxable amount will be number of the shares that are given. If it's given for free, the number of shares given times what you call, times the market price. Together, team, give me a yes. Times the market price. Give me a yes if you're together. Scenario 2, if it's given shares at a discount, if it's given these shares at a discount, if it's given shares at a discount, if it's given shares at a discount. So the taxable amount in that scenario, taxable amount would be, we say number of shares given times. So we have the market price, then you have the cost given. Remember, it's not given by what's called by the employer. So this will be the taxable the amount. So the taxable amount is given as a discount. So how do you get the discount? Market price, it means that the market price is more than the price given by the employer. So it's number of shares given minus what's called the cost given by the employer times the number of the shares that are given together times the number of shares that are given. So in the next class, whatever is remaining is small. In the next class, we shall start on those revisions of those areas. That is on a Friday. That is on a Friday. We shall start on revision on those areas. So I want to say that God bless you. Keep up the good work. We are headed to the final lap. This is the time that we don't need to miss because we're about to start our revision. This is the time that we need a lot of consistency. We need a lot of sacrifice to make a lot of sacrifice. But I can tell you we have tried. Where we have, if you look at the whole syllabus where we have, we thank God we are not in a bad position. So by next week, we should be done. Next week, we should wrap things. And this week and the other week, we should wrap things and begin a massive revision. So I want to say that God bless you and God bless our class. Keep up the good work and keep on supporting Focus Online College. Always remember us and support us. Thank you so much. We close it there. Unless somebody has something that cannot be postponed. Joy, do you have something that cannot be postponed? God bless you, Naomi. A good night, Florentina. God bless you. Thank you, Samikis. God bless you, Joy. Thank you, Aaron. God bless you.